Okay, all right. That was great. Computer crashed again. Seems like the more I stream, or the longer I stream for, something happens and maybe I run out of memory, but I'll figure it out in the future. Let me check these, keep these monitors on form. Maybe I'll catch it again. Okay, so welcome to part two. We just talked about inflation, 3,000%. That's crazy, right? 3,000% inflation since the year 2000. Absorb that. Now, divided by 100 to figure how many times. We've got the little calculator on inflation here. We'll probably do the same little calculation. But 3,000 divided by 100 is what? 30. Hello? Enter year 1999, 2024. That's an interesting adjustment. What just happened there? Didn't we not just see a much larger value? Oh, did I not? Oh my God. Okay. Screw me for that one. Okay. Well, then that adjusts some stuff. So, part two, correction. I didn't press the freaking calculate button. Still not so crazy. We've got $1.89. Man, how was I not looking at that? That did seem a little extra, didn't it? I'm gonna have to redo that whole thing. All right. Well, starting from scratch. My whole argument was based on heavy inflation, but that's in the early 1900s. It's pretty intense after gold standard was bustling through. So let me scratch that. This is going to be just part one. And might not even be a part since I may not crash this time. All right, so let's readjust some previous assumptions. I mean, technically, we don't have enough data to go all the way back to 1990s or 1920s, so that's something that we can't really estimate. But okay, that actually makes me a lot better at like, it makes me feel a lot better because I was almost like my eyes almost popped out of my face looking at that. All right, so if we've got a near 100 inflation, 89% since 2000. We've got a $1 is 189. We're nearly doubled, so we can say it's about a, let's see. I mean, that's basically giving us an 89%. Reversing that, we can essentially take, yeah, we can essentially take the 189 divided out from our market. Okay, that actually makes me feel a lot better. A lot better. So let's take our 155, will be a lot more accurate here, divided by 189. Fair value is around 82 bucks. Okay, now that seems a lot better. Okay. Sometimes, you know what? Math just doesn't math right. We can ignore this now. This is the more fair valuation. Okay. Since 2000, again, we can continue the argument from way back in early 1900s, but that's a pretty decent amount of time. And the gold standard was removed much more towards the middle of the century. So we shouldn't have to have a concern that we're going to go way back there. However, there's a case there. 610, more reasonable. What's the current valuation after inflation? 322. Hey, that actually falls very well. That actually falls perfectly with technicals. Every time we approach, we go above certain placements, certain huge evaluations, we have to touch back. So technicals state that, hey, yeah, we went through this. We broke through, it's too yellow. So we broke through this resistance, but technicals always have a case for corrections, falling back down to specific locations for a test. Because in the end, the outcome of those tests is for sure an upward movement. Whoa, hello. We can see that happening multiple times in the past in any trend or any particular market, whether it's an individual stock. But in the case of a SPY, the S&P 500 on the market, we're going to essentially see that happen more often because when accumulation of multiple stocks follow this technical pattern, you're going to see the same and a much more dependable pattern downwards, or at least support touch. As right now, this was a case for resistance. This line acted as resistance. Tap, 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 break. We had a bit of a, 2020 issue here, but we did bounce back up. We never quite tested it again. One of these should have led us to go down enough to test it and then healthily keep going. This is how the market naturally moves. We can see that here. Resistance, correction, resistance, correction. At least two before the third one ends up being the next bull rally. So as we can see in this case scenario, there's our first test. Well, hold on. We don't even have a second test, actually. So there's only one test on the resistance. If we take a look at the resistance here, we tap that resistance 1, 2, and then 3 with a breakout. Here we've done 1, 2, 3 with a breakout. In normal case scenarios, we should see another test on the support. But we kind of know that this location here, after 2008, was printed money. This was a case of bank stimulus from 2008 financial crash that essentially goes up, and we never had that ability to test down in order to continue going up. One can say these are tests. However, not necessarily complete tests. Man, this makes so much more sense now. Before I was like, no way, there's no way, there's no way we can get down there. I had a previous assumption that it would have been $20. So we can scrap all of that based on the inflation factors. But we still have some correction based on inflation. Just not as drastic, maybe from early 1900s. But I don't even think that can travel so far in time. I mean, we had 1929, that was a pretty decent correction, the Great Depression. So we kind of went through that already. We shouldn't have to readjust or feel that again. So that does do a good part. But I do want to again point out some of the patterns that we still, even though everything as far as inflation didn't quite make sense in the previous attempt at this chart, we do have 1, 2, 3, I'll call it here 3, 4, and then the potential exponential growth. Now, for anyone that knows a little bit about history, we're kind of are still within the branch of this, not as extreme, but this happened in Germany out of control without automation, without any sort of fail safes, which we have in the current market. This one would be, let's say, essentially the dot com. If we were to correlate the values, this would be GFC, this would be COVID-19, and you are here, AI. So this still plays a decent part. Now, the two directions can happen. I mean, three options are now possible. I can really say, since the adjustments to inflation seem pretty decent now, we have a continuous growth with light stimulus. We have a market chaos, and this is a case for companies not being able to pay because people are not buying, because people cannot afford to buy, because the stimulus has always gone to corporations and banks and not the people themselves to continue the consumer market. Or we have a slight breakdown, and then we can continue back on the upward trend. Okay, so a little bit different. I didn't go through as much detail than the previous video, but man, that inflation calculation really threw me off. So as far as looking at the general inflation effect, $300 or $600 currently is worth $300, about 320, 30, what the calculators say, 322. So in reality, 322 will be right here. In reality, from 2000, at least in the pre-inflation values, we've doubled in true valuation. This is the standpoint of true valuation based on 2000 pre-inflation value or dollar power, the power of the dollar. So if this is potentially that midpoint, we got to evaluate a couple of factors here. First is the fact that we've identified inflation has basically given us a bubble. This is a bubble. Whether it's AI, whether it's something else, we know the evaluation up at this point is having an issue. We know that big banks are defaulting on commercial estate, real estate. And this is strictly and specifically due to work from home. Office buildings are becoming empty. They're considering in New York specifically how to convert an office building into a residential dwelling. There's a couple of factors that are an issue here, like trying to have every apartment have sunlight. Office building is pretty thick, and at some point you will have a middle of the building that is not capable of having real light come in. And as human beings, we need light. Okay. We have credit cards falling behind on credit because wages have not kept up with productivity. A lot of individuals, in this case, 8.9% of delinquencies, sure, this is only starting from 2024, and it can't continue to go because there are cases where people are literally buying food on credit. Their rent is going up, their food is going up, everything is more expensive, and they're running out from their paychecks and they're depending on credit to make ends meet. So this is still a cooking factor. Also, commercial real estate is a cooking factor. Germany hyperinflation starting to look less likely now. We do have a much nicer exit from this exponential hyperinflation. And this is potentially what the Fed is trying to prevent. This would be horrible. This would be absolutely insane. Now, based on the charts you're seeing here, what I'm seeing are patterns. I'm seeing a particular type of automated pattern in the way markets are moving that are relative to the past. RSI is very obvious in this particular factor. So I want to first point out this pattern we see here, this pattern we see here before the 2008 crash, and this pattern we see here. 2000.com, maybe even before, but it seems to be slightly misaligned, maybe due to some factors like less usage of automated algorithms. 2008, we have a lot more people in the market. This is also a factor of potential increase in the stock market. We have Robinhood, we have Webull, we have access to the free market as an individual retail trader. So as more money flows in, more upward momentum. And then we're seeing that after each of these particular automated saw waves, we run into some problems. 2000, we see that dropping, that sort of extreme volatility in the RSI dropping. Here we also see that dropping and this kind of harmonizing. So potentially we may see something soon as well. Now, this is the bare bone of the analysis. I want to go a little bit further, zoom in, because right now we're doing the 1 week. We're doing the 1 week on a specific type of analysis that I'm looking at. Mathematical analysis, if you will. We are dividing the future by the current. ES1 are future contracts attempting to foreshadow the possible prices of the future of whatever you're trading, whether it's oil, corn, milk, hogs, or the overall S&P 500. SPY, on the other hand, is the currently traded value on the market as individuals trade live. What's inside of SPY? Well, biggest possible cases, we have Microsoft, Apple, Google, we have Facebook, or what, Meta now, we've got Nvidia, we've got Tesla, we've got countless big giant companies. And if you wanted to essentially participate in the market, one would buy the SPY in order to gain benefit from all of these companies in one basket. That's the technical observation. So we are taking the future and dividing by the current, attempting to see a pattern. What I saw was interesting, and I've already pointed out this factor, and this factor, but that's not the interesting part. We're going to go ahead and zoom in on the daily. This is where it gets interesting. We have a harmonic saw wave happening month by month. I believe, no, this was not a month by month basis. This was a 90-month quarter by quarter. Let me check. Yeah, 90-day quarter by quarter basis. There's this saw wave that essentially shows an interesting pattern. And that's essentially what I do. I find patterns in